Welcome back. You are listening to Whissel Wednesdays here on AM 1170. The Answer. My name is Kyle Whissel, your host with Whissel Realty. Joined as always by Mr. Jason Hall.
Yes, sir.
East Village.
Hey, just Chargers, man. San Diego Chargers, just keep them here.
Take them anywhere they go as long as they stay in San Diego.
If they leave, again, we're going to keep the name. We're going to do what we can. The San Diego Chargers will always remain the San Diego Chargers.
Love it. And Mr. Dave Elhoff, Elhoff Wealth Strategies. Dave, you're dropping some serious knowledge on us before the break. We're talking about the market and where it's better to have your money invested, sitting in the bank, in real estate. I got a call from a financial advisor the other day that was trying to tell me that right now they believe that it would be smarter, instead of having, a typical portfolio of stocks and bonds primarily, instead of being heavy on stocks and light on bonds, shifting a little bit and moving more money into bonds and less money into stocks. What's your thought on that?
Well, you taught me something here. It depends upon what you're doing.
So, full disclosure, at the break, Dave asked me, how's the real estate market? And the correct response is, it depends. Are you looking to buy, sell, rent, or invest? Because it does change depending on, what avenue you're looking to take.
Yeah, and when it comes to bonds today, now it's interesting that you bring that up, because right now what happens is that things happen and suddenly everyone decides to follow a winning strategy that might have worked last year or last month. And right now, what looks and appears to be cheap for time to invest are things that produce income, like high-yield bonds. Now, high-yield bonds, they figure, is a good place to be because interest rates are remaining low, and you can still clip coupons in that area around 5 to 7%. So many times there are strategies out there with the high-yield bond portfolio, the core bond portfolio, and the short-term bond portfolios, putting that together and getting a dividend being paid to you or interest being paid to you while you're waiting for some appreciation. Many times those high-yield bonds act very similar to stocks. They can go up in value on a whim, and they can go down the same way depending upon whatever interest rates are going. There's a lot of other issues when you come to bond. It's not only the yield that we're looking at. We also have to look at the credit worthiness of who the institution is that is agreeing to pay that interest rate. And then we're also taking a look at what is the maturity levels on this. So again, I would temper that enthusiasm where you go let's move out of stocks and move into bonds. It depends. It comes down to what that individual's risk tolerance is. But I'll tell you something, what's really interesting, Jason and Kyle, is that the only factor out there in the formula for most financial planner out there that is consistent is time. If you take a look at the monetary unit, the money that you're investing, the dollar, that dollar is constantly losing purchasing power. The other one is the rate of return on that dollar. That rate of return, many times what Wall Street uses is average rates of return. The problem with that is average is not actual.
Right.
And when you get done with it and you find out that you averaged an X amount of rate of return, the actual is much less.
Right.
So the only thing that is accurate in a formula that most people use out there is monetary unit at a rate of return over time is time. Time is the most precious thing that we have. You guys in the business that you're in, you understand that you run out of time many more times than you do out of other things. And time is the one thing that we got to have. And most people, if they have patience, they can wait for the returns to be where they need to be.
Okay.
And that's really key. But what happens, the average investor, they lose that patience because if you look at returns of the stock market, the average rate of return, which is not accurate, of being 8 to 10%, and you look at the average investor and their rates of return, the individual investor is like 3.5 because they get out at the wrong time, they get in at the wrong time, and they allow their emotions to determine what their strategies
Because they're not patient, right, Dave? I mean,
Exactly.
The average person is just not patient. We've seen all these day traders over the last 10 years prop up, and some did well for a while,
Yeah.
right? Because you could pick anything, and boy, you're winning, and money's now cheap, and so they're still able to pick, and things are doing well. So, talk about patience.
Yeah, exactly. The thing is that you got to have patience. You're in the real estate business. You understand this, is that, look, the house you bought today has some expenses to it. And the house you bought today isn't advertised in the paper every day of what it's worth. If you were to change your mind tomorrow after you close on the house today, are you going to get more than what you paid for it? Chances are no.
Right.
And it's not, but you got to have patience. And then that comes to reason. The patience has to be, why are you purchasing the home, what you brought out? Are you purchasing it to rent it, to flip it, to live in it, whatever the reason is? And if you're purchasing a home to live in it, then you shouldn't be looking at instant increase in value. I mean, the times that we have the flippers going out there and buying the model homes, turning around after 30 days and flipping it and making 50 grand. That doesn't happen, and it's short-lived when it happens.
Right.
It's always short-lived. I've been, and Jason, you've probably been through several real estate cycles where you know people
Yeah, he
that
knows.
have done that.
Yeah, even,
I saw agents make $1 million and then lose it all a few years later trying to do the same strategy because they didn't make a change, but where they were buying model homes like that.
Yeah.
When the market shifted, they were still buying and didn't realize wasn't a good time to buy.
And you're talking during the break, too, is that the one thing about a home is that it takes upkeep.
Yeah.
You got to make sure that home, if you want to get top dollar, and you know this, Kyle, you go in and look at people that let their houses become a piece of crap. They're losing hundreds of thousands of dollars because they don't have it modernized, up to speed. They don't have the systems in there. So not only do you need to have patience, but real estate just doesn't automatically go up. You got to take care of it.
right.
You got to pay the taxes. You got to do the maintenance. You got to take care of those things. But if you do those things, it can be very rewarding.
Absolutely. Again, you're listening to Whissel Wednesdays here on AM 1170. The Answer. We're talking with Dave Elhoff, Elhoff Wealth Strategies. If you ever want to connect with Dave, give us a call, shoot us a text, 619-663-SELL, 619-663-7355. One of the things that I've noticed, Dave, is that I come from an investor background. I worked in commercial, I've done flips, own rentals, all that stuff. And, for me, for a long time, it was really hard to understand that when I'm buying a house for myself to live in, to raise my family in, I have to look at it a little bit differently than when I'm looking at the house that I'm going to flip or the house that I'm going to put a renter in. It's a very, very different thing. And, the house that Brittany and I bought, if anything, we might have overpaid for the house. We paid top dollar for that house. But I am perfectly okay paying top dollar for the house that I actually have to live in. I don't care how good of a deal you get. If you are scared to walk out your front door at night because it's a rough neighborhood, or the only place I can walk to is, Vaughn's to pick up some mac and cheese and some top ramen, is it really worth it? Is it really worth it to make those sacrifices just to get a deal? I think too many people are very short-sighted when it comes to making that
They look
purchase.
at costs, and it's a minor blip that if they're a long-term investor or a long-term homeowner, that's going to be very minor down the road.
Definitely. So we're going to head to a break here on Whissel Wednesdays. When we get back, Jason, I want to get the latest on what's happening with the mortgage market. You're listening to Whissel Wednesdays here on AM 1170, The Answer.